Thanks for tuning in, Dividend Dashboard here. Around a month back, I made a video about ChatGPT analyzing my portfolio, giving me the advantages, risk, and tips to improve. And even though I agreed with some of the statements, the overall tips were somewhat weak. This time, I'm doing something a little different. I'll be sharing my Google spreadsheet where I track my portfolio, and ChatGPT will be asking me both simple and complex questions about it. Think of this as an Ask Me Anything style video, so you can get a better understanding of my thought process and investing style. I'll include timestamps for each question in case you want to jump to a specific one. And as always, feel free to leave your own questions in the comment section below. I'll be happy to answer them. Let's dive in. Question number 1. With a yield of 2.35%, are you intentionally prioritizing dividend growth plus total return over current income? Yes, I'm still young with decades of investing ahead. I don't need the income now, so I'm focusing on total return with high dividend CAGR. Question number 2. Are non-low yield growth names, example Google, a permanent piece of your dividend strategy or opportunistic as you trim later? Low yield companies in my portfolio like Google, Visa, Apple, Microsoft, MasterCard are core holdings to elevate my portfolio's total return. Despite having very low starting yield, they do offer a fast growing dividend. I don't view them as an opportunistic addition to trim later, especially since they are still growing. The only way to sell is if the fundamentals fully deteriorate. From the ones mentioned, Apple slowed down dramatically, but still brings in a lot of cash flow. So that is why it remains in the portfolio as a whole. Question number 3. Do you drip everything or selectively reinvest into the best value/quality at the time? For those who don't know, DRIP means dividend reinvestment plan. This is when your dividends get automatically reinvested for you. The only companies with DRIP in my portfolio are Apple, Google, and Microsoft. The rest of the dividends are manually reinvested. Question number 4. Top 5 companies equal 38% and top 10 companies equal 63%. Is that your target level of concentration, or would you prefer to tighten or widen it? Well, I do want my high conviction core holdings to be my largest holdings within my portfolio, at least taking 40 to 50% of it. However, one of the companies I heavily bought in the past was Hershey's, a consumer defensive company which battles between the number 1 and number 2 spot for the largest holding with Google. I'm slowly reducing my Hershey exposure by investing in other higher growth businesses so the allocation goes down and balances the portfolio the way I like. Question number 5. Tech at 46%. Do you have a cap for tech weight, or is that unacceptable given their dividend growth runaway? I do know that tech companies that pay a dividend usually have a super low yield with a double-digit CAGR, and that is fine by me as long as it is that way. If the company is buying outstanding shares, that's even better. Now, to answer the question, the allocation of 46%, I'm okay with that. I know the portfolio is somewhat tech heavy, but the same applies to the benchmark, so I have no concern of underperformance or sector risk. Question number 6. Any target sector where you're aiming for? Example, real estate 5 to 10%, healthcare 10 to 15%. To be honest, nothing specific. One of my goals this year was to high grade the portfolio, and that included reducing my exposure to consumer defensive, which was limiting the overall growth of the portfolio. It went from 30 to 20%. I don't mind if it continues to be reduced, but overall, I don't aim to anything specific in terms of sector. Question number 7. 5 tickers generate 49% of your income. Is that okay, or do you want to broaden income sources so a single cut doesn't dent cash flow? Absolutely. I would like to broaden my income, and that is happening week by week as contributions continue to enter the account and deployed on opportunities. Some companies pay a higher starting dividend compared to others, so that might take a while to increase. Besides realty income in Hershey's, which their payouts looks disproportionate, the payouts overall looks balanced. Question number 8. Your income hotspots are realty income, Hershey's, Starbucks, Texas Instrument, and AbbVie. Which of these are your must own for a decade versus under review? Let's describe them one by one. Realty income is still growing, very slow, but it is still growing. If you have it in your portfolio, I recommend having it at 2 to 3% allocation with this holding. Hershey's, hands down, the best consumer staple in my opinion. Consistency, sustainability, and pricing power. Starbucks, this one is under review for me. Strong brand with world-class recognition, however, it's a cyclical business and is showing weakness. I'll have to revise my thesis on this one. Texas Instrument, chip giant and still expanding like a monster. Expansion to the stock price will be seen when that mega factory is finished. And last, AbbVie. Despite facing intense competition with Humira's generic brands, the company overall stayed afloat. Their other stellar drugs hold up good as well. Alright, now that all companies are mentioned, Starbucks is under review. I'll have to revise if this is a company I would like to hold for a decade. For the rest, Yes, I can comfortably hold. Question number 9. What's your 12-month income goal? Example, $1,000 a year. How much of that should come from new capital versus dividend growth versus rotation? Well, at the start of every year, I set my yearly goals. For the dividend income at the end of 2025, the goal is $600. How much should come from new capital versus dividend growth versus rotation? I personally don't track it that way. I just note down the dividends received and move on. Question number 10. If you got $5,000 today, how will you split it within your current names versus new tickers? The options are lift yield to 2.5% to 3% without sacrificing growth, or keep yield at 2% but maximizing dividend CAGR. The options are tricky, but I think my portfolio is positioned right now to be at the best of both worlds. Market beating returns and a double-digit dividend CAGR. My current yield is 2.35%. It is a weighted dividend yield, which means that it's based on the stocks I buy. If I heavily buy a low-yield stock, the portfolio yield will go down. Now, if I were to receive $5,000 and invest it, the first $1,000 will go to Google. The company is currently undervalued as we speak. I will use $3,000 for my core holdings, and the last $1,000 I will use it to fund my defensive/high yield dividend payers just to maintain the stability and the dividend snowball rolling. Question 11. Which holdings would you add on a 10 to 15% dip today because the business quality is unquestioned? I will add Google, Visa, and MasterCard. Actually, Google dropped heavily since the insistence of ChatGPT, and that was a very good entry point for this company. The stock recovered, but still undervalued to me. For Visa and MasterCard, man, they're a dominating duopoly with a massive network effect. So getting a temporary discount on the stock will definitely be a great buying opportunity. Number 12. Rate cuts 200 basis points. Do you plan to scale up REITs, example realty income, or just let the position re-rate? I'll let the position re-rate. My realty income holding is already heavy for the slow growth steady dividend it provides. Question 13. Recession playbook. Who do you expect to prove resilient? Waste Management, Procter & Gamble, Pepsi, AbbVie. And who might disappoint? Cyclical/consumer discretionary. Any preset trim ad rules? Well, for the companies mentioned, I believe all will do alright in a recession environment. With Waste Management, people will need their trash to be picked up. For Procter & Gamble, personal care products are always needed regardless of the economy. Pepsi could face a bit of trouble because people cut back on snacks and soda. However, affordable prices could help them keep afloat in a weak economy. For AbbVie, depending on the necessity of their drug. Overall, the companies mentioned have the capability to hold a recessionary environment. For the cyclical in my portfolio, I say Starbucks. Consumers tend to cut on discretionary spending extremely quickly in weak economies. I cut companies when fundamentals have heavily deteriorated with no sign of improvement. Question 14. You have large winners, example JP Morgan Chase, and a sizable weight in Google. Do you have a profit-taking framework, example trim back to max weight, redeploy to underweight income names? Well, it's not in my plans right now. I'm still young and in the accumulation phase. The companies mentioned are still expanding with no sign of slowing down. The profits are not that big for me to sell some shares. Question 15. Hershey's is a top weight in a laggard. I am down $347, yet a top income contributor, $83 a year. What conditions will trigger add, hold, or exit? To be honest, I heavily bought Hershey's last year. Right now, it's a hold. When the company recovers in price, it causes the allocation to go up, making it the largest holding in my portfolio. It is a great company to own, and for me, it's the best consumer staple out there. I just don't want to slow the portfolio down when there's other high growth opportunities to put my money in. Question 16. Do you benchmark against SCHD/SPY on total return and or income growth? What's your acceptable tracking error versus those? In my portfolio updates, I benchmark against the S&P price return. In my Road to 100K series, I compare with all the indices. Now, at the end of the year, I do the total return comparison. Question 17. By 100K invested, what's your target yield range and dividend growth rate? Probably it'll be around 2.5% weighted yield with around 8% dividend CAGR. Question 18. What monthly contribution are you planning? If by contributions you mean depositing money, I'm waiting for my employer to set up the 401k so I can get the match. When it comes to my dividend portfolio, I'm investing $160 a week, and for now, I'm at my limit, unless I get a pay raise, higher paying job, or a side hustle. Question 19. How will you react emotionally if your top 5 holdings underperform for 3 years while high yield names soared? Will you rotate or you stay the course? I will stay the course. If the fundamentals of the company remain strong and the stock price falls, that creates a buying opportunity, buying within the margin of safety and continue holding. When it comes to my emotions, I stay well grounded and analyze the situation before making any movements. There's no need to panic. Question number 20. What's your cash buffer policy? Always fully invested or keep dry powder? Always fully invested. If my buying power has a balance, it means I was super busy and forgot to buy. Question 21. Will you ever average up, keep adding even after 50% gain, or is your mindset more about averaging down value entry? I do a lot of average up constantly, especially on winners that continue to expand as a business. Buying winners at all-time high or average up doesn't hurt your long-term gains. Again, especially if the company is expanding. Question 22. At what portfolio size, say 100K, 250K, 1 million, will you consider changing your approach to dividend yield versus growth? I say between 1 to 1.5 million. That will be enough money to cover my expenses and retire peacefully. By retiring, I mean doing what I like sports, travel, optional labor, and so on. Question 23. Your portfolio has 21 effective positions. Do you think that's enough diversification, or would you rather prefer 25 to 30 effective names? Yes, absolutely. I think that's enough. I am company and sector diversified. You don't need to participate in every sector or have massive amount of individual stocks in order to have enough diversification. Studies say that around 15 individual stocks is enough. I have 6 extra above the threshold, and that is because the companies I own play a role in the portfolio, and the purpose of each one brings the combined effort to currently beat the market. Question 24. If the market dropped 30%, will you A, add aggressively, B, hold steady, C, trim to protect gains? I will add aggressively. I will even tap into my savings to buy more. When you look at the amount of bear markets versus bull markets don't happen that often and they are shorter. Those are opportunities you want to capitalize by investing in your high quality businesses. Question 25. Are you aiming for financial independence through dividends, or is this portfolio more of a wealth compounding sidecar alongside your 401k, S&P 500? Just like most of the topics in finance, it depends. Dividends eventually will cover some of my expenses. The question is, how much of it? What happens if by that time I have a part-time job that I love, and the combination of the job and dividends cover my expenses? Or if I have a monetized YouTube channel that pays me enough and there's no need for me to even touch the dividends? I don't know. I feels like it's too early to tell, even though I have a slight idea of it. Now, for the 401k part, that's just an extra buffer for my retirement that I could possibly do the 4% rule or simply move it to blue chip companies for extra income and preserve cash. Question 26. If you had to explain your strategy in a 1-sentence rule to your future kids, what would it be? Always invest in high quality companies that consistently grow their dividends so your money works harder for you year after year. So that will be it for this Ask Me Anything video. Hope you enjoyed this type of content. Let me know in the comment section below what type of questions do you have for me. Hit like and subscribe if you haven't. Thanks for watching, and I'll see you in the next one.